Thank you for joining us for today's webcast. I'm Jeff Rogers, a tax partner at Feeley Driscoll. Feeley Driscoll is a Boston-based regional business consulting firm with years of experience helping small and mid-sized companies grow their businesses. Should you have any questions following this presentation, please call us at 888-875-9770 or visit us on the web at www.fdcpa.com. Today's webcast is going to be on the tax implications surrounding distributions from S-corporations. On the surface, this may seem like a strange topic, since most people recognize that the most significant difference between a C-corporation and an S-corporation, from a tax perspective, is the fact that distributions from an S-corporation are generally not taxable. The key word is generally. By and large, distributions from S-corporations are tax-free. That is the beauty of an S-corporation. With C-corporations, you first pay tax on earnings, and then you pay tax again when you draw the money out of the company. This is not the case with S-corporations. However, just because the general rule is that there is no second level of tax, that does not automatically mean that everything that you take out of the company once you're an S-corporation will be tax-free, and here is why. If you were previously a C-corporation and you made an S election, if you had not yet distributed out all the earnings and profits that accumulated during your C-corp years, you will have to pay the second tax upon the distribution of those C-corporation earnings, even once you become an S-corporation. The good news is, you are not required to pay this tax on the C-corp earnings immediately upon becoming an S-corporation. More on that in a little bit. So does that mean if you were an S-corporation from day one of your existence, that you do not have to worry about distributions from C-corporations' earnings and profits, and that none of your distributions will be taxable? The answer is yes and no. Yes, of course you would not have to worry about distributions from C-corporation earnings and profits if you were never a C-corporation. However, you still could have a situation where distributions from an S-corporation are taxable, and that brings us to the concept of stock basis. Plain and simple, you cannot take a distribution from an S-corporation that exceeds your stock basis in the corporation. So what is stock basis? Well, think of it as your investment in the company. You create basis when you buy the stock, whether it be directly from the company or from an existing shareholder. You create basis when you make a capital contribution to the corporation. Gifts and inheritance can also result in basis to the recipient. When you own an S-corporation, your basis in your stock adjusts annually as the S-corporation generates income or loss. That's because, as a pass-through entity, you are reporting the income, or deducting the loss, on your personal tax return and paying the related tax. So on that note, if your basis is increasing as you generate income, and you never distribute out more than you make in a given year, could you ever wind up with a taxable distribution in excess of your basis? Well, it really comes down to what your measure of income is. Are we talking book income or taxable income? If taxable income, then you should be fine, because base adjustments are made as income is taxed. Oftentimes, however, book income and taxable income can be considerably different. Now, why might this be the case? If you're employing a different method of accounting for tax purposes, perhaps you're a contractor using the completed contract method, you could be recognizing income for books a year or two ahead of when you are for tax purposes. The cash will be collected throughout the life of the contract, and if you prematurely distribute it to the shareholders before the income has been taxed and basis created, you could have a taxable event. You might also be taking advantage of accelerated depreciation methods for tax purposes, such as Section 179. Accelerating depreciation for tax purposes drives down your tax basis. So the point is that you need to be cognizant of your taxable income and be mindful of its impact on your stock basis. If you're an S-corporation without any prior C-corporation earnings and profits, it is important to realize that ordering rules exist for stock basis purposes, and they're actually fairly taxpayer friendly. Specifically, first, stock basis is increased by income items. Secondly, basis is decreased by distributions, and third, it is decreased by loss items. Why does this ordering matter? Well, let's suppose you didn't have any basis coming into the year, and you generated $600,000 of ordinary income. You expensed $500,000 of fixed asset additions under Section 179, so really your net taxable income was $100,000. If you took $400,000 out of the company during the year, do you have a problem? Without understanding the ordering rules, you might think yes. After all, taxable income was only $100,000. However, the ordering rules allow you to first increase your basis by the $600,000 of ordinary income, and then decrease it by the $400,000 distribution. That leaves you with $200,000 of basis, which means you can only deduct $200,000 of Section 179 in the current year. The remaining $300,000 will be suspended until additional basis is created. The point is, though, that distribution was not taxable. One point I would like to cover quickly is distributions of appreciated property. If the company is distributing an item out to a shareholder that is appreciated, the amount of the distribution is going to be the fair market value of the property, and the shareholder will receive the company's basis in the asset. However, in addition, there will be gain recognized in the amount that the fair market value exceeds the basis, and the amount of that gain will be reported on Form 1120-S and will pass through to the shareholder to pay the tax on it. The amount of that gain will increase the shareholder's basis. And on that note, we're going to shift our focus and spend the rest of our time discussing the taxability of distributions when C-Corporation earnings exist. As previously mentioned, if you had undistributed C-Corp earnings and profits at the time that you made your S election, you'll have to pay tax upon the distribution of those earnings. Knowing how the IRS works, you might expect that the first money that comes out of the company post-S election would come out of the earnings and profits bucket. The truth of the matter is that is not the case. There are very taxpayer-friendly ordering rules that are in effect that basically stipulate that before you need to dip back into those C-Corporation earnings and profits and pay the related tax, you can first distribute out your S-Corporation earnings. With that being the case, how do S-Corporation earnings get tracked? Well, you may have seen this would be on page 5 of the Form 1120-S. Schedule M2, which is alternatively referred to as the Accumulated Adjustments Account. This account represents the history of income, losses, and distributions that have occurred since the company made their S election. The balance in the account starts at zero on day one of the first S-Corp year, and as taxable income is generated, it increases. As taxable losses are incurred, it decreases, and as distributions are taken, it also decreases. As long as the Accumulated Adjustments Account maintains a positive balance, that is, cumulative income exceeds cumulative losses and distributions, the distributions will not be taxable. However, once this balance reaches zero, any distribution subsequent to that will be taxable. The cumulative adjustment account can be negative as a result of losses that have occurred during the S-Corporation years, but never as a result of distributions that have been taken. There are some slight differences between stock basis and AAA. For example, AAA does not increase for tax-exempt income, whereas your stock basis will. Likewise, it will not decrease for any expenses that are associated with that tax-exempt income. A common example would be officer's life insurance. An increase in cash surrender value does not increase AAA, rather it increases OAA, which is the other adjustments account. And the non-deductible officer's life insurance expense is a deduction that runs through OAA rather than AAA. AAA is not going to increase for any contributions to the corporation. If you contributed cash into the company, it gets treated as additional paid-in capital in your financial statements. That increases your stock basis, but it does not increase your AAA. You need to be aware of that. Similarly, any outside transactions, perhaps you spent money up front to purchase shares from another stockholder, that increases your basis, but not AAA. As you can see, it is extremely important to accurately maintain this AAA account so you have a handle on when a distribution reaches a point that it would be out of your C-Corporation earnings and profits. The one other difference between stock basis and AAA that can come into play are the ordering rules. We previously spoke of the ordering rules for stock basis purposes. To go back, as a reminder, income items come out first, followed by distributions, and then loss items. A similar concept applies for AAA income items, distributions, and loss items, except that back when we were talking about stock basis, we spoke about how you would split up income items such as ordinary income and Section 179 expense, and distributions would first be applied against the income items. For AAA purposes, they cut to the chase, and they net all income and loss items together. And if it lines up that you have what is referred to as a net positive adjustment, in other words, if all of your income items exceed your loss items, then that will increase your AAA prior to the distribution. If you have net loss items, which typically result when you have an ordinary loss for the year, that net loss item will come after your distributions have been recognized. The result is if you reach a point where a distribution taken from the company occurs after the AAA account has reached zero, that distribution will be a distribution of C-Corp earnings and profits up until the point in which you have distributed your entire C-Corporation balance. The distribution is taxed as a qualified dividend. At that point, once you've distributed all of your C-Corporation earnings and profits, you can then utilize additional stock bases such as bases from capital contributions or tax-exempt incomes as a means of taking additional funds out of the company tax-free. But first, the C-Corporation earnings and profits get distributed from the company. Going back to our original example, if your AAA balance was at zero to start the year and you had $600,000 of ordinary income with $500,000 of Section 179, you would have a $100,000 net positive adjustment for AAA purposes. The first $100,000 distribution will be tax-free, but at that point, AAA will have been reduced to zero. The additional $300,000 will be taxable up to the amount of your undistributed C corporation earnings balance. If you do not have $300,000 of C Corp earnings, you can use other non-AAA sources of basis to avoid paying tax on the excess. If by chance you have exhausted your stock basis, you would pay capital gains tax on the distributions in excess of basis. At this point, I think we have covered several of the nuances of distributions from an S corporation and when they can be subject to tax. Should you have any questions and you would like to discuss your situation further, please feel free to contact us at 888-875-9770 or visit us on the web at www.fdcpa.com. Thank you for joining us.